you, Chris, and I know I'll be joined here by my panelists here shortly. There's one right now, Brad, and Kevin, I imagine, will join in just a second. Terrific. We've got everybody. Thanks again, and delighted to be here, everyone. Looking forward to an interesting conversation around the SaaS deal environment, including operating metrics, valuations, and so forth. We have a couple of great panelists here, as Chris mentioned. Kevin Kemmerer, who's an operating partner with Clearlake Capital, one of the most active investors in software and involved in a bunch of different companies himself personally. And Brad Delizia, Senior VP of Corporate Development and General Counsel at Alemica, where he has helped build a great software company as a member of the executive team. And this company has also attracted some fantastic private equity backing in its history. So we'll let them do a little bit better introduction for themselves. But topics we'll address today is the capital environment, a little bit about COVID, some about operating metrics, a little bit about valuation, and a little bit about doing deals from an M&A perspective. And obviously, all those topics influence M&A, quite frankly. Love to encourage everybody to ask questions as we run through the topics. We'll leave some time for Q&A at the end, but I'll keep an eye on the chain of questions that's scrolling across the screen and potentially jump in with some questions as we go through. So with that, let me kick off, and I'll ask Brad and Kevin to tell us a little bit about their companies and their roles, just for setting the context. Kevin, why don't we start with you?
Sure. Good afternoon, everybody. Nice to be part of M&A East again. My name is Kevin Kemmerer. So as Rob mentioned, I'm an operating advisor with Clearlake Capital. We're a large PE firm doing a lot of different types of deals, but I focus on the technology sector, almost exclusively SaaS businesses. And I'm currently executive chairman of a couple companies, and one I'm actually the CEO of the business on an interim basis right now. One's called Dude Solutions down in Raleigh, North Carolina, and the other one's a company called Simpler in Houston. So we spend a lot of time thinking about M&A as a key driver for our growth. And it's a key value driver that we have, as well as Rod said, optimizing all those operating metrics that we focus on every day. So I have a good mix of both PE background. I was an M&A banker years ago with Rod, so have some experience there, but I spent most of my last 10 plus years on the operating side with SaaS companies.
Yep. Hi, Brad Delizia. I've been with Alemica since 2002, and if you don't recognize the name Alemica, we were formed. We were one of those dot-commers that were industry based. We were formed by about 32 chemical companies, oil and gas, and rubber companies, and been with the company ever since. I was hired on as their legal counsel, as their GC. Ran product management for about 5 years. And then have been doing corporate development, I think, for about 15 or 16 years. We kind of left I would call it the consortium model in 2016 when we were bought by Thoma Bravo. It was a great time. It was probably the first time we kind of realized what we should be as opposed to what we were, which was, I think, we were a consortium, and we had to transition to becoming a SaaS company, which Thoma did a great job at doing, and we did so well that they were able to sell us again in 2019. Now we're owned by a French combination private equity, a little bit of bank, kind of a little bit of everything, named Eurazeo. And we've done about 6 M&A transactions over my history, but 3 have really been coming over the past 18 months. We really have a strong push on growth. I would say Thoma was more of an Ebitda play, and now with Eurazeo, it's certainly on a top line play and expanding our product portfolio, which we operate in the supply chain execution business.
Fantastic. Thanks, guys. Well, good. Well, let's get on to the topics here. So let's start with the elephant in the room that everybody loves to talk about, which is COVID and the impacts on folks' business. Now, ironically, of course, software companies in particular, but the technology space has seen, to be at least some level of a safe haven in this world of COVID. Certainly rallied better than most coming out of the darkness of March and April. I'd love to get a better perspective from you all as to why that may be. So maybe the best way to address that is kind of what have you seen the impact to be on your business, and what measures have you taken to mitigate or even take advantage of the COVID environment? Brad, maybe we should start with you.
Yeah, I mean, the great part is, we've been set up almost working remotely for a long time, and we could have. Everyone has laptops, mobile phones. We're kind of used to working on those two platforms. So, having to shut down offices, which we did worldwide. We have an office in the Netherlands, in Germany, and in Atlanta and Philly. We shut them all down, and it was great. It was seamless. I mean, to me, if anything, the one thing I've been pushing at the company is when we're doing internal meetings that we do the video calls. And so that reinforced it. And I think that was a way for us to kind of stay in touch as a culture and as a team. Our customers really didn't see much of a tail off because we're measured on transactions. So how many purchase orders, invoices. So if there's a slowdown in the process industries, we feel it because volume goes down. We didn't see it. I mean, and you can expect because a lot of our customers were actually providing PPE to manufacturers, and so we didn't see a slowdown at all. We saw a little bit. We're also operating in the automotive space and the tire industry. That saw a little bit of slowdown with plant shutdowns, but in reality, it wasn't that big. Everyone knew it was kind of temporary and coming back. Really, the biggest area that I think we've seen issues is really in the sales side. Not that we did a tremendous amount of trade shows, but that was an aspect of our marketing to get new logos. So with that, kind of going by the wayside, I think that has just shifted us to say, okay, we got to figure out how to get new logos. So we're now concentrating more on the website to get that influx of new customers. So it's really, I think, if any, the kind of transition how to doing business from one-on-one going to a company to meet someone to saying, okay, now I got to figure out how to get to these same people or talk to these same people on a Zoom call and still have the same impact and interaction that you do in a remote setting versus a live setting.
Yeah, I think your comment about sales is a salient one because I think, speaking to a bunch of companies in the software universe, certainly some did RIFs or headcount reductions, most just delayed headcount, but certainly the area where they saw the most expense reduction was in sales and marketing, just not spending on travel. And when their growth plans weren't as impacted as they thought they were going to be, a lot of these folks ended up with better EBITDA than they thought they were going to end up with.
And that's when you're looking at companies, you have to take that into account where the revenue, we're kind of saying the new revenue growth this year is flatness. It's okay to be flat this year, but you're certainly seeing an increase in EBITDA, and you just got to make sure you say, okay, this is a one-time blip. It's going to go back up. So make sure you don't kind of take that into your model.
Absolutely. Kevin, what about you? You look across a few different companies.
Yeah, so I think one of the great things about SaaS companies is you're almost always dealing with mostly recurring revenue. I think both the companies I work with are 90+% recurring revenue. So, that is a great starting point, right? When you know that you're going to have a slowdown on the sales side. In terms of how hard you're going to get hit on the sales side, I do think, the key takeaway both from Brad's comments and what I've seen is you got to look at the end industries that you're actually serving. So one of my companies is in the healthcare IT space. There's no question we could not get anybody to pick up the phone and have any conversations about selling something new during February, March, April, May, June timeframe. However, the plus side, if there's a silver lining there, is nobody's canceling their contracts in that time either because they just don't have time to focus on their maybe particular piece of business when they're so focused on getting PPE and other things. So end industry, I think, is critical. We serve several different verticals. Healthcare IT, it sort of depends on what segment you're in healthcare. In the government space is actually been a really big boon for us. So one of our companies focuses on the government market, and the CARES Act has been a really nice savior for us that we're actually seeing more budget available because of the CARES Act, and that's allowing us to sell even beyond our original budget expectations in the government space. So I think that's what we're seeing on an end market. The other big thing that this does, and Brad highlighted, if you put a magnifying glass on sales, you really start to think about your bookings from, how much is from new logos, how much is from cross sells, and how much is from upsells to existing customers. And you really, where you may have sort of had a blend of whatever that it might have been pre-COVID, post-COVID, everybody knows those numbers cold, right? You're tracking every cent and which bucket they're going in and why, and where do you focus and why. and which campaigns are getting returns. So, as Brad said, getting leads in, marketing, all those marketing campaigns for new logos is really hard and being scrutinized really heavily now. But, how we convert on cross sells and upsells into our current base is something I don't think we've ever spent so much time figuring out. And it's been a huge boon for us that we have, very loyal, resilient customer bases in which to, mine for those new opportunities.
And I would also add on that point, certainly the upsell cross sell is something that people turn to during the depth of the April-May timeframe, right? Maybe not the best time to go out and sign new customers, but a great time to be going and talking to your existing customers. So we've seen a lot of companies where that ratio was skewed pretty dramatically in the June quarter. But then also the feedback is our pipeline has never looked better, right? Particularly for companies like security companies and folks that obviously enable remote work. But going to the beginning of your comment, Kevin, the recurring nature of the revenues from most software companies today makes it very resilient. I mean, resilient is the word that you hear describing software and why the tech boom has happened post-COVID. For sure, combine that with the sales and marketing expenses being lowered. It's just been the go-to space for a safe haven. So anyway, well, that's great. So now I'll ask you to look into your crystal ball, sitting where you sit today. How do you feel about 2021? And that probably changes on a daily basis depending on, headlines from Europe and headlines from the election. But tell us what you think. I'll let that be a jump ball.
I can go first since I'm in the middle of budget, season with companies. And so it's not the easiest time to try to predict, how much you want to spend on marketing, for example, when you're not quite sure, what the market's going to look like. I think one of the things that I've learned through this process is, with the COVID environment, what you can see is it's not that hard to pick clear winners from clear losers in a COVID world, right? There are certain segments that are absolutely going to benefit in a post-COVID world, and there are other segments that are going to really struggle, right? And so, one of the key things to think about with, trying to figure out that crystal ball is how do you position yourself to be a true, category winner in the COVID, in a post-COVID world. And I think that's fundamental to, how much you have to maybe change course of your business and how much you might need to change between 2020 and 2021 is making sure you understand how well you're positioned in that post-COVID world. So that's how we're thinking about it. I think we're hopeful that, no matter who wins the election next week or however many weeks it takes for us to figure that out, there's going to be, additional stimulus and spending on certain categories, and we want to be well positioned for that. Same thing with healthcare. The healthcare market is overwhelmed with certain characteristics today. Some of those things that we need to do with the healthcare industry, you can actually absolutely be well positioned for going forward. So I think, we do expect growth next year. We don't expect to be flat. We expect to be up. We're certainly driving Q4 quite nicely with our companies. And so we're expecting pretty strong growth. And we're also expecting that we're going to continue to push the pedal as hard as we can on M&A because we're seeing a lot of M&A opportunities as companies are sort of honing their own strategic direction and they're shedding assets that aren't as strategic or maybe some companies have not been able to figure out how to position or don't have the critical mass to do that positioning into the right space. It gives us an opportunity to be, strategic and move really aggressively to take advantage of the post-COVID world.
Again, I think from an operational perspective, we're certainly expecting, the kind of what we have today to continue through the first half of next year. So meaning, sales guys got to figure out how to sell, in this environment, and same with marketing. And we're doing everything we can to kind of ramp that up. So I'm not expecting next year to be anything equivalent to this year in terms of, let's say, flat revenue growth. I think you have to get back to the trajectory that you were on pre-COVID. And I would concur with Kevin. To me, this certainly when COVID hit, I think a lot of deals were paused with bankers, and we're kind of traditionally kind of two funnels. We've got bankers, and I have my own private pipeline that I go after. And the same thing happened on the private side. All CEOs said, "Brad, let's talk in 2 months. Let me make sure that I can get my business to run during this period, and then let's retouch base." And I've already seen a pickup. I was looking at my numbers. The number of banker-led deals that have come over come out this year versus last year is up by 200%. I've been stunned. And they're all good properties. They're all properties that were, in my pipe. So it's great to see. I can see that continuing. I think if anything, we're about to, in the next 3 weeks, we're going to be signing and closing a deal that was 100% done in COVID. So it can be done. It's just done differently. And I think if anything, during the kind of the remoteness of COVID, we've actually figured out how to do more touch with companies rather than, because you're always kind of forced to maybe have face-to-face meetings. And now it's just like you can have it every other day if you really, really want to. There's no pause here. So I just think I think the M&A is going to continue. And if companies are in good shape, they're going to be able to take advantage of the metrics that are out there today.
Yeah. Good. Well, that's a great segue. And Brad, just to add a little more color to your comments, as one of the bankers who are running around in this space, I've never had a busier August. I think in recent memory,
Right.
Certainly in the last 10 years. I think going into the summer, I sort of expected things were going to be relatively quiet for me and get to enjoy my summer a little bit more. But boy, was August ever crazy. So absolutely. But yeah, that's a great segue to the next topic, which is the capital environment. You touched on this a little bit, Brad, so maybe I'll throw the ball over to Kevin. I mean, you both kind of wear hats of buyers and sellers at some level. And I'd just love to know sort of how would you describe, what words would you use to describe the transaction landscape today, both from an M&A standpoint and from a fundraising standpoint? I'll just leave it open-ended.
So I'll start, I guess. I like Rod, we started out together actually a long, long time ago. I hate to say how long it was, but I have never seen a more robust transaction environment from a valuation perspective, at least an Ebitda valuation perspective, in the SaaS space since the late 90s when we were doing this a long time ago. So, it's the frenzy. I
don't think that was Ebitda then.
Yeah, we didn't call it SaaS back then. But the frenzy is off the charts for good properties. There's no question about it. And I'm not sure it's every sector, but every sector I'm involved with, it seems that way. A lot of folks have been trying to get deals done pre-election. So that's been a huge driver for the summer. I just looked it up. Since February, we've done 5 deals with the 2 companies I've worked with. So that's, all of them effectively done. 4 of them have been done almost exclusively in the COVID world. So we're being super aggressive. There's a ton of activity, but we feel like it's a time to be strategic. The valuations are high. The valuations are really high for us. And I think just like Brad and I both had exits from Thoma Bravo backed businesses last year at very high valuations. So it was high last year. I don't think it's abated at all from a multiple standpoint, but you're talking about, 15 to 20 times Ebitda multiples, forward Ebitda multiples are not uncommon. There's been some deals that have been done even higher than that in this market. And these are, 50, 100, 200 plus $1 million revenue companies generally that we're seeing in the market being sold. So if you have critical mass and you get Ebitda and you're rule of 40 or rule of 50, you're going to see those multiples because lots of folks are interested in platform businesses to buy. And frankly, it's almost exclusively a private equity market. There are a handful of strategics out there willing to bid, but most of the deals that I've seen have been done by private equity, trading from one PE firm to another. So it's a great time to be a seller. And if you're well positioned, having the critical mass and the ability to affect the operating leverage on the buy side, if you buy at 15 times Ebitda and you can, post synergies, it's a net 10 times Ebitda, and you think your business is worth, 15 to 20 times Ebitda, you got great arbitrage opportunities out there. So buying up critical mass right now has never been, more important for us.
Yeah, and I guess I'll emphasize, you see those 15 to 20 when you're, 40, I would say $40+ million in revenue, and I think you're operating at a good clip on Ebitda plus, I would say plus 30%. So certainly expect that. When you get down to the smaller end, let's say the $5 to $15 million, again, I think they're still very, I think they're still good at good market rate at this point. I kind of say I always like to trend it when I'm talking to CEOs and what they think. There's a little bit of, I think there's always a little bit of hype. You always think your company's worth more, but I think oftentimes, we're just looking at, are we at market? That's the thing. We're always trying to figure out, compare what we're trying to do for a private company that we source on our own versus someone that a banker is coming to us. And again, I think there's always a premium of 15 to 20%, so that we can always kind of get a feel for what market is there. But again, I think the difference is that we're seeing nowadays is, at least 4 years ago with Thoma, it was certainly all about revenue growth. That's what they wanted to see. They wanted to see that your top line was really growing. Now it's about profitability. I mean, that's really what it is. It's less about the top line. It's more about profitability, or can you get to profitability? That's because oftentimes when we're looking at companies, they may be on the verge of profitability, or they're at less than 10%. But we're saying kind of, well, within our hands, can we get them up to 30 to 35? And I heard on the session this morning on the PE roundtable that you've stopped kind of looking at the trailing 12. I think trailing 12 is certainly, you're always looking at trends. There's no doubt about that, historical trends on how you're doing. But we tend to value based on, kind of your current year or the following year. I'm tending to do the following year at this point to say, what do we think it can bring? So to me, if I was a CEO and owner of a company, I'd always be thinking about that as saying, in a market like this, profitability does mean a lot, or at least a road to profitability. To be able to show that and demonstrate it and do it with confidence is really important. But otherwise, I think valuations are in the capital market. We're doing a deal right now. It's probably going to be $50 million in debt. There's a huge market out there for it. They got people lining up to fulfill that debt for us. So it's not that hard to get capital. If anything, some of the private companies that I've talked to that are thinking about getting capital, I'm always telling them, you might as well go out there for a sale too. It doesn't hurt. It's the same amount of information. The banker will still get paid either way. They'll take either one. But it gives you choices. It gives you options. And again, especially with the uncertainty of the capital gains treatment, it's probably the right thing to do. It's probably put my lawyer hat. I'm probably in your fiduciary obligation to do it as well. But you never know. It's great to compare.
So you both made very interesting references that betray your private equity roots. You referred to Ebitda Multiples, right? And that obviously makes sense. I guess my question for you, and by the way, Brad, you also mentioned, hey, we want to make sure we're at market or what have you when we're paying for a company. When do you feel it's appropriate to look at a revenue multiple as opposed to an Ebitda multiple?
We do all the time. We start with Ebitda and we do a gut check on revenue. So they're always in there. It's just, we lead with Ebitda because, that's, I'd say one of the metrics that we always look at is cash Ebitda. It's important for us. It just is. It's how we've done our last two exits. So, I get it. But we absolutely look at revenue multiples. We do. That's kind of the check to make sure we're not kind of missing something.
Thank you, Kevin.
Yeah, I think the way I look at it is, every business that's above, 20 to 50 million in revenue is striving for that rule of 40 or rule of 50, or, I've even seen some rule of 60 companies out there. So, you're trying to optimize one way or another your revenue growth against your Ebitda margin. And I guess the way I've seen it is, if you're growing at 10 to 15% a year, you're really focused on Ebitda, margins and growth, and you really don't. You don't want your revenue growth to slow, but you're not going to get paid on a revenue multiple if you're growing at 10 or 15%. If you're growing at 20%, 25, 50 or more, a lot of firms were growing 50+% a year ago, not so much right now, but once you trade above, or once you're growing above 20, 25%, now you sort of enter the world where you can justify a revenue multiple. And then you go to the crazy extreme of a snowflake, which really, they're valuing at 400 years in the future to get the valuation. But again, that's tied to revenue growth. It's not tied to anything related to profit. So I think that's the threshold. You got to just pick, what you're targeting and so what your 2, 3 year, 4 year horizon is of what you're trying to do with the company. And then, you hope that the market still, valuation wise looks similar to what you're planning today.
So you pose it as an either or, and I don't disagree with you by any stretch, but let's take it to the extreme here for a second. Do you feel like there is a death valley to some degree where you don't want to be in the middle,
Yeah.
right? You either need to choose to be slower growth and high profitability or higher growth and low profit and no profitability even, but to be a little bit of both is just maybe not great.
You just nailed it. I literally just walked through that with one of our management teams. I call it the valley of death, exactly what you said. And the idea is if you're growing at 10% and 15% EBITDA, that's not going to get anybody excited, right? You're not leaning one way or another to get anybody excited. So yeah, you do need to lean on one side or the other. You can't be in the middle on both. You will not get rewarded in the public. Well, I shouldn't say never, but it's our experience that you'd rather build the business assuming you're going to lean one way or another than try to be caught in the middle.
I would absolutely concur. To be, when I see, which I have a couple in my pipeline, are companies that are growing at 8% and are at 12% EBITDA. If anything, I look at them, I'm kind of going, all right, what are they? And the companies that I have are almost like what I was, 4 years ago. They're kind of an industry consortium. So I take a look at that and I say, look, that's a great opportunity for EBITDA arbitrage. Absolutely, because there's going to be a lot of synergies there I can take care of. The issue is when the valuation expectation is a lot higher. That's when you're kind of going, I'm not going to meet. You can't bridge that gap to either you are kind of a rule 40 and rule 50 and you're doing it well and you get it, or you're not. And sometimes the owners just don't understand that. And you don't understand why you can't get the number you want. You're just kind of going, the fundamentals aren't there. That's why I love bankers. They can help explain that.
There you go. Thank you. Well, that's great. Super, super helpful to hear that. What I'd like to do is shift gears a little bit. And by the way, I'll make the one statement back on the prior topic. When you try to figure out what you want to be, obviously one thing you need to take into consideration is what do you think your exit is? Right? If your exit is to an EBITDA-oriented buyer, if you are an industrial software company and you think an industrial technology company is going to be the buyer to you, a 15% growth company with 20% EBITDA is probably easier to get a deal done with than a 50% growth company with no EBITDA, quite honestly. Or if you're headed public, the public is going to value revenue growth more so than probably anything else. So you don't really get a lot of credit for profitability. So there's a lot of nuances. You can't just say, I want to be this. You have to think about where you're headed as a potential liquidity event. So moving on, Brad, you made the comment about we want to know that they're profitable or how to get them to profitable, right? And how to get them to profitable kind of steers us in the direction of unit economics, which raises the whole question of SaaS operating metrics. Let's start with what do you track in your own companies and why did you choose them? How does that lead to improving your business? Give us some color there.
Yeah, that's easy. I mean, being owned by a private equity fund, I have to give it to them, every month. So, it's the stuff that you would always expect. It's bookings, it's churn, upsell. Our debt is based on a covenant for cash EBITDA, so that is obviously something that we track very specific, very hard. And then ARR, because that is always something that, when I look at companies, I'm always looking at the ratio between professional services and ARR, and we do the same thing. Because sometimes they're not aligned. You need to be doing the professional services that leads to ARR growth. If it's not, something's wrong, and that's always kind of a trigger that we look at companies. But after having 2 exits, I think we've learned exactly what you need to show potential buyers in a sale process, and it's the same things that we look at on an internal basis. I mean, we do gut checks on percentage of revenue to R&D and to sales and marketing and to G&A. These are kind of all gut checks saying, boy, do they sound right? Are we spending enough money in these locations? If not, we got to figure out if that's something that we want to do. So, I'm going to say cash EBITDA, revenue, ARR, ratio to PS, ARR to PS. We're always looking at churn because that is always a leading indicator. If you have high churn, you kind of say, boy, maybe it's not truly an ARR business. Maybe it's not it just kind of feels like it is, but maybe it's not. Because you really want ARR to be sticky. That's kind of how you get through COVID. So to me, it's all the metrics that you would put in a book with a banker is the metrics that you measure, because that's what you're going to be putting in your book when you're for sale.
Yeah, let me jump in on that. So I couldn't agree more with Brad's last statement. So we talked about the recurring revenue being the foundation of SaaS businesses. So the number one thing we care about, whether it's our business or anything we acquire, is the actual retention or churn, the inverse of retention. So if you think about it, if I have a business that maybe has 10% churn or 90% retention on a gross basis, that's usually a pretty good company. You're effectively losing 10% of your 10% of your book out the door, right? Most companies, once you get to 50, 100 million in revenue, they're only putting on new bookings of around 20% or so, sometimes a little higher, sometimes a little lower, but you're only adding about 20% of your current platform, assuming how fast you grow. But most of the businesses I've seen are growing at 10 to 20%. So you're only putting on maybe 20% of new bookings, on the platform. And if you're losing, 15 or 20 out the back, you're basically flat, right? So it's a disaster, right? So, that retention, making sure your clients are happy, making sure that, your NPS scores are high, making sure that all your services projects are being done on time and on budget. All those things that you measure around retention are so fundamental to our businesses. So that's always the starting point for me. Then you sort of look at the top line and say, all right, let me take a look at my customer acquisition cost against how much business I've actually generated and how efficient is the sales machinery. So that's super important. As businesses get bigger, so you're 50 or 100 million of revenue, you're typically not selling one product anymore. You're selling 3 or 4 or 5 products. So now you have this concept of an attach rate where you might sell one and have many, add-on sales in the future. So one of the big drivers of valuation is what's the white space in your existing customer base. And if you have 100 customers about one product and 1.2 products and you have 8 to sell, well, you got a ton of white space. That's a lot of TAM and a lot of opportunity right within your wheelhouse, right before you have to go launch a new product or go after a new market or anything else. I can just look at what's in my baseline. So those are some of the things that we look at, from a quality of the growth opportunity standpoint. And then you put your Vista hat on, Vista Equity, and you start looking at operating leverage and all the metrics Brad talked about related to, I'm at this, the market is at that, and Rod at KeyBank publishes an awesome report on stats, and it tells me all the places where I'm good and bad with respect to my operating metrics, and then I can figure out where I'm going to get more operating leverage out of the business by pulling a couple levers to make those things better.
And again, I think all those metrics are not, I would say, deal killers. Like if you have a high churn or let's say your ratio from PS to ARR is out of whack, I don't walk away from a deal. If anything, we tend to look at product first and is it a fit? And then we start looking at financials. It's why. It's always the question of why. It may be, you're just small enough and you don't have a client success team and you just kind of go, great, I have one. So we can immediately put that on existing clients and start retention, or like as Kevin was saying, is adding a company to, let's say, to Elemica gives us another product. We go from 18 products to 19. So I'm just taking their client base and saying, I can sell them 18 products to start on day one. So I was to say all those metrics we look at, and we always, the next question is why, and we'll figure it out. And we'll figure out if it's something that is truly a deal killer and it's just something that we kind of go, what, we can walk away from this, the valuation expectation to what we believe it's worth is too high, or we just kind of go, it's okay, I think we can fix that. And we'll give you the benefit.
I just want to make an observation that we're 40 minutes in. Brad and I are both former product guys, and we didn't talk about product for 40 minutes. This is amazing.
Well
done. Gold star. Well, look, I'm gonna let you even go a little further outside your comfort zone, perhaps for a second. Probably the last question, quite frankly. So you'll have to ask it quickly. But if anybody has any questions, throw them up on the chat. Culture. in this Zoom environment, in this remote environment, culture has always been one of the biggest things that makes or breaks an M&A deal. It can kill a deal. It can make it super successful. How do you assess culture in this world?
That's a tough question.
Yeah,
I'm gonna let Brad go first.
Yeah, it's twofold. Because on banker-led deals, the banker tells me what to do, and I can try as much as I can to meet as many people in the organization. So we tend to go with our gut. That's a big thing. You can judge a lot by the management team. I can tell you that for now. We walked away from a deal that I thought we were gonna love because something wasn't vibing right with the CEO and owner. We just said, you know what, it's just not looking good. When it comes to the private stuff, most of these people I've been talking to forever. So, COVID really hasn't changed anything. I kind of get a feel for kind of, I think what their culture is like. But the deal that we're working on right now, we've just tried to get to as many people as we can on Zoom calls. That's been in one-on-ones. That's been our biggest thing and the banker's been great about it. Even though we got to them privately, they hired a banker to kind of get them through the process. But to me, you just got to do those one-on-ones. It just, you take it out of the group framework and you say, you know what, I'm going to talk to the head of sales one-on-one. And I think that's how you will end up, getting a feel for, do they have the same kind of culture and vibe? Are they going after client? Can we make the client more successful? So it just takes digging, a little more digging.
Yeah, I think from what we're doing on our standpoint, number one, your own company has to have a core foundation culturally, right? So for us, with one of the companies I spend time as a CEO, our core values are critical, right? We talk about them every day with the company, whether it's a recruiting discussion or, how we improve some of our internal processes, whatever it is, our core values come into play. So we talk about it a lot. That makes it a little easier now when we're looking at an M&A deal and we say, well, let's just talk about our core values with respect to the M&A deal. And Brad, I feel the same way as Brad stated. It has to be through a lot of one-on-one calls. It's also through a lot of reference calls. So we do call a lot of customers. We ask them, tell us about, integrity. It's one of core values. Tell us about how they've treated you over time. How well have they upheld their commitments, right? So we'll ask questions tied to our core values. And I will tell you, with the Zoom world, as frustrating as it is to be so monotonous, we've just done deals in Australia and in the UK and other places, and being able to sort of cruise through, sessions with different folks around the world on Zoom, as if you're, in your conference room next door. It's actually been pretty efficient to get through that. So, it's not the end of the world. I think we're going to change for forever the way we do some things like that and get more comfortable, using Zoom when we need to.
Yeah, I think that's right. I have a client in Australia now that probably wouldn't have taken on 12 months ago, but here we are, and it's working great. So totally agree that the geographical boundaries have become not only meaningless, but also an enabler through Zoom. So good. Thank you, guys. Hi, Christy.
Thank you.
Hi, how are you?
Good. I know why you're coming on.
Here I am. This is Christy Delmuto with LLR Partners. I wanted to say a quick thank you to all three of our panelists here, Brad, Kevin, and Rod. That was a really interesting discussion, and I think reflects well what we're seeing in the market too. So thank you.
Thank you very much, Christy. We'll sign out now.
Okay.
Thanks, Christy. Bye, everybody.
I also want to thank Troutman Pepper for sponsoring this session along with LLR. As some of you may know, we are a lower middle market private equity firm investing in technology and healthcare, and on the technology side, particularly in SaaS businesses. So this was a very interesting discussion to be a part of today, and we're glad to be a sponsor. Just this past week, we closed our 6th fund at $1.8 billion, and so we're welcome conversations about SaaS investment opportunities, both in the near and longer term. So just to close out the session, I'll give you a couple housekeeping notes. After this, you'll all return to the ballroom floor for networking for 15 minutes before our final program of the day, called The Evolution of the Deal Process and Expectations for 2021. Certainly a hot topic for all of us. I'll also give a personal shout out for our women's program tomorrow morning at 9 a.m., where we're going to have a fireside chat with Jennifer Openshaw about elevating women and girls in finance. So thanks again for everyone for attending this session. Have a great evening.